January the 2nd, 2026, right now. Something is happening in the silver market that most people are completely missing while they are arguing about stock picks and crypto pumps. Samsung announced developments in solid-state battery technology that could reshape silver demand entirely. The technology shows promise for commercialization, with small-scale production targeting 2026 for wearable devices like the Galaxy Ring. But here's what matters for silver. Industry analysis suggests these batteries could use significantly more silver than conventional EVs. Not the 25 to 50 grams found in today's electric vehicles. Estimates point to roughly 5 grams per battery cell, and for a typical 100 kilowatt-hour battery pack, that could total approximately 1 kilogram per vehicle. China implemented export licensing restrictions on refined silver. January 1st, 2026. Not proposed, not threatened, implemented. They control 60 to 70% of global refined silver supply. And as of yesterday, you need a government license to export it. And here's the number that should make you pay attention. Current electric vehicle production uses 25 to 50 grams of silver per vehicle. Industry projections show global EV sales hitting over 20 million units in 2025, with analysts forecasting 22 million in 2026. That's millions of new EVs annually, each requiring silver for battery management systems, power electronics, and charging infrastructure. The supply situation isn't theoretical. It started becoming visible in 2025, and what I'm about to show you is how three forces, Samsung's technology development, China's export controls, and accelerating industrial demand, are colliding right now to create what could be the most severe silver supply constraint in modern history. Because this isn't about investing. This is about understanding that the physical metal that powers electric vehicles, solar panels, AI data centers, and defense systems is moving from abundant commodity to strategic resource. Let me show you exactly what's happening, what these developments actually mean, and why the next 90 days could reveal whether markets understand supply constraints or whether complacency persists. Samsung announced something at their SNE Battery Day that didn't get nearly enough attention. All solid-state batteries, claims of 600 miles of range, 80% charge in 9 minutes, 20-year lifespan, and a silver-carbon composite anode that changes the equation for silver demand. The technical innovation is straightforward. Traditional lithium-ion batteries use liquid electrolytes, flammable, unstable, limited. Samsung's development replaces the liquid with solid oxide electrolyte, non-flammable, stable, and critically, it enables the use of a thin silver carbon layer that prevents dendrite formation and enables higher energy density. The numbers matter here. According to industry estimates, each battery cell in this technology may contain approximately 5 grams of silver. A typical 100 kilowatt-hour battery pack contains about 200 cells. The calculation suggests roughly 1,000 grams per vehicle, about 32 troy ounces, 1 kilogram. Compare that to conventional EVs. Current battery electric vehicles use 25 to 50 grams of silver total, mostly in electrical contacts and power electronics. If Samsung's technology reaches scale, that represents a 20 to 40 times increase in silver content per vehicle. Not 20%, 20 times. And here's why the timeline matters. Samsung confirmed in January 2025 that production targeting is underway. They're supplying prototypes to their divisions for use in 2026 devices, Galaxy Ring, wearables, small format applications, but the larger target is automotive. BMW signed evaluation agreements in October, prototype evaluation vehicles expected late 2026, commercial automotive production targeting 2027 and beyond. The production timeline isn't immediate mass adoption. Samsung's CEO stated they're investing in production facilities. The technology has demonstrated performance. Energy density tests show approximately 500 watt-hours per kilogram, roughly double conventional lithium-ion. The safety profile tests favorably. The charge time shows improvement. The lifespan projections exceed current batteries. But here's where the implications become clear. Global car production sits at approximately 80 million vehicles annually. If solid-state batteries using this silver-intensive design capture just 20% of that market over time, we're discussing 16 million vehicles, each potentially requiring 1 kilogram of silver. That projects to 16,000 metric tons of annual demand from automotive batteries alone, eventually. To put that in perspective, total global silver mine production in 2024 was approximately 835 million ounces. That's roughly 25,960 metric tons. If Samsung's battery design scales to 20% market penetration, it would theoretically consume over 60% of annual mine production, not 60% of available supply, 60% of what comes out of the ground every year, and that assumes 20% adoption over several years. If solid-state batteries prove superior in performance and safety, which early testing suggests they might, adoption could accelerate. 50% market share by 2030 would represent 40 million vehicles annually. 40,000 metric tons of silver, more than total annual mine production from all sources combined. This is the Samsung variable. Not an immediate shock. A developing pressure with production timelines that extend through 2027 and beyond. Now let's discuss what happened January 1st, 2026. China's Ministry of Commerce implemented new export restrictions on refined silver. Not proposals, active regulations. Here's what changed. Any company wanting to export refined silver from China must obtain a government license. The licensing requirements create significant barriers. You need annual production capacity of at least 80 tons. Most small and mid-sized refiners don't meet that threshold. You need state approval, subjective, political, controllable. China released a list of 44 companies approved to export silver in 2026 and 2027. 44 companies. In a country with hundreds of refiners and thousands of traders. This represents concentrated control. Why does this matter? Because China doesn't just mine silver, China refines it. Between 60 and 70% of the world's refined silver passes through Chinese infrastructure. Even silver mined in Mexico or Peru often gets shipped to China for refining because they have the capacity and technical expertise. The export licensing system means China can now influence the flow of refined silver globally, not through price alone, through permission. If they approve your license, you get metal. If they delay your license, you wait. If they deny your license, supply becomes constrained. This mirrors what China implemented with rare earth elements. In 2010, China controlled approximately 95% of rare earth supply. They implemented export restrictions. Prices spiked significantly. Industries adjusted. Western governments attempted to secure alternative supplies. More than a decade later, China still controls substantial portions of rare earth supply chain segments. Silver is following a similar framework, but with one critical difference. Rare earths were largely unknown to the general public. Silver is visible, traded, priced daily. The restrictions are forcing markets to confront physical reality more immediately. And the timing is notable. China didn't implement these controls randomly. They implemented them at a moment when industrial demand is rising, and Western technology companies depend on reliable supply. Responses have been measured but clear. Industry leaders have noted on social platforms that silver is needed in many industrial processes. That's not panic, that's recognition. Tesla needs silver for vehicles. SpaceX needs silver for satellites. Technology companies building AI infrastructure need silver for data centers. China's action signals control over access. Here's where the supply situation becomes uncomfortable. The silver market has been in structural deficit for multiple consecutive years. From 2021 through 2025, cumulative deficits approach substantial levels. Total shortfall over 5 years reaches approximately 820 million ounces. That's nearly an entire year of global production missing from the system. 2025 alone saw a deficit of approximately 115 to 120 million ounces. Demand reached roughly 1.24 billion ounces. Supply, including mine production and recycling, provided approximately 1.01 billion ounces. The gap was filled by drawing down above-ground inventories, and those inventories have been declining. COMEX registered silver inventories in the United States are down substantially since 2020. London vaults, traditionally the world's deepest silver storage, have seen volumes decline. In June 2022, London Bullion Market Association vaults held 31,023 metric tons. By early 2025, volumes had fallen to approximately 22,126 metric tons, a drop of roughly 1/3 in less than 3 years. This is the baseline. Before Samsung's solid-state batteries reach commercial automotive production, before China's export licensing creates processing bottlenecks. The system was already showing strain. Now consider the demand drivers. First, automotive electrification at scale. Second, solar deployment accelerating. Third, AI data center construction expanding. Let's examine electric vehicles because this is where current verified demand exists. Global EV sales in 2024 reached approximately 17 million units. Research forecasts project over 20 million in 2025, with estimates of 22 million for 2026. That represents substantial year-over-year growth. Gartner research suggests 116 million EVs could be on roads by 2026, representing approximately 30% growth over 2025. Current EVs use 25 to 50 grams of silver each, according to Silver Institute data. At 20 million new EVs annually using an average of 35 grams, that's approximately 700,000 kilograms. About 22.5 million troy ounces annually from standard EV production using current technology. But that's existing technology. The calculation changes if Samsung's solid-state batteries gain market traction over the coming years. Early adoption in premium vehicles during 2027 and 2028 could begin shifting the baseline upward. Full market impact would take years to materialize, but the directional pressure would be clear. Charging infrastructure adds another element. Each EV charging station requires silver in power electronics, contactors, and control systems. The National Renewable Energy Laboratory estimates the US alone will require 28 million EV charging ports by 2030. That infrastructure represents additional silver demand beyond vehicle production. Solar deployment adds significant pressure. In 2024, solar installations added substantial new capacity globally. Multiple sources reported strong year-over-year growth. Each gigawatt requires approximately 1.9 million solar panels. Each panel contains roughly 15 to 20 grams of silver on average, according to industry data. Calculations suggest hundreds of millions of panels installed annually require substantial silver tonnage. Solar has become one of the largest industrial consumers of silver, with photovoltaic applications representing over 30% of industrial fabrication demand. And solar demand is accelerating because of AI data center power requirements. Data center electricity consumption is projected to double by 2026 and potentially quadruple by 2030, according to multiple energy forecasts. A single large-scale solar installation capable of powering a hyperscale data center requires hundreds of metric tons of silver. Then there's AI hardware itself. Each AI server depends on numerous high-performance connections, where silver's conductivity provides advantages. Semiconductor applications are expected to consume increasing amounts of silver through 2030, though not massive individually. The growth trajectory is clear. Add defense systems, medical devices, 5G infrastructure, consumer electronics, multiple sectors increasing consumption simultaneously. Industrial silver demand in 2024 reached a record 680.5 million ounces, according to the World Silver Survey 2025. An 11% increase from 2023. Projections suggest industrial fabrication will continue rising, potentially exceeding 750 million ounces by 2026. The challenge is clear. Demand is rising across multiple sectors. Supply faces structural constraints. Silver mining presents unique challenges. Approximately 71 to 72% of silver comes as a byproduct of other metals: lead, zinc, copper, gold. Only about 28 to 29% comes from primary silver mines. This creates structural inflexibility. When silver prices rise, miners don't necessarily increase silver production. They increase production based on the economics of lead, zinc, copper, or gold. Silver revenue is treated as a credit that reduces costs, not a primary investment driver. This means even if silver prices double, supply response is limited. The base metal mines that produce most silver aren't expanding based on silver economics. They're expanding based on copper demand or zinc prices. Primary silver mines face their own constraints. Ore grades are declining at mature operations: Peru, Mexico, Bolivia. The high-grade deposits are depleting. What remains requires more processing, more energy, more cost to extract less metal. New mine development takes 8 to 12 years on average. Discovery, permitting, construction, ramp up. Even if a company decided today to build a new silver mine, production wouldn't start until well into the 2030s. Too late for demand pressures materializing now. Environmental permitting has extended timelines. Jurisdictions have become more cautious, communities more engaged in approval processes, regulatory frameworks more detailed. The barrier to new production is higher than in previous decades. Capital intensity remains challenging. New silver mines require $500 million to over $1 billion in development costs. Average capital expenditure for new silver mines has increased substantially from 2015 to 2025 levels. And recycling isn't solving the constraint. Silver recycling in 2024 rose 6% to 193.9 million ounces, according to the Silver Institute, a 12-year high. But that's still only about 16 to 19% of total supply. Industrial scrap saw increases, mainly from spent catalysts. But silver in electronics remains difficult to recover economically. A smartphone contains about 0.3 grams of silver. When the device is worth $50 in component value, extracting 0.3 grams of silver at current prices presents economic challenges. Solar panels lock silver away for 25 to 30 years. And even when panels reach end of life, recycling infrastructure remains limited. Most panels currently don't see silver recovery. The mathematics present challenges. Annual recycling adds approximately 194 million ounces. Annual demand exceeds 1.24 billion ounces. Recycling covers less than 16% of demand. The remainder must come from mining, and mining output isn't growing rapidly. If Samsung's batteries scale faster than expected, if China's licensing creates even modest bottlenecks, if AI infrastructure build-out continues accelerating, the deficit could widen substantially beyond conservative estimates. And when deficits persist for multiple consecutive years, when above-ground inventories decline, when industrial users face supply constraints, prices begin reflecting physical scarcity rather than paper market dynamics. Silver prices in 2025 showed substantial gains year over year. From approximately $30 at the start of the year, prices moved significantly higher, with reports of levels around $64 in December. Some sources reported brief moves above that during periods of heightened activity. This movement isn't purely speculative. Industrial buyers are securing supply. When manufacturers realize just-in-time procurement carries risk, they adjust strategies. They negotiate long-term contracts. They pay premiums for guaranteed delivery. Physical premiums tell part of the story. Reports from late 2025 indicated silver lease rates reaching elevated levels, with some sources citing annualized rates around 30 to 40% in October. In normal market conditions, lease rates typically run 1 to 2%. Elevated lease rates indicate tightness in physical availability. Spot silver and physical silver can diverge. Paper contracts trade at exchange prices. Physical metal in hand trades with premiums that reflect actual availability. This spread indicates physical supply constraints beyond what exchange pricing alone reveals, and China's licensing system could widen that spread. Because even if exchange prices adjust, if export licenses limit flow from China, physical availability becomes constrained. Price becomes less relevant when supply is controlled through administrative approval rather than pure market forces. Analysts have raised price targets based on structural factors. Bank of America raised 12-month projections. BNP Paribas analysts suggested scenarios reaching $100 by late 2026 under certain conditions. These aren't speculative extrapolations. They're based on supply deficit analysis, export policy impacts, and technology-driven demand projections. Historical context matters. In 1980, silver reached $49.45. Adjusted for inflation using standard calculators, that represents approximately $170 in current purchasing power terms. Current prices around $60 to $65 remain below inflation-adjusted historical peaks. But 1980 was driven by attempted market manipulation, speculative, unsustainable. The current situation differs. The demand is industrial, structural, essential. Companies need silver to build solar panels, EV components, data infrastructure, defense systems. They face limited substitution options without sacrificing performance. And that's the key distinction. When demand is speculative, price spikes collapse when speculators exit. When demand is industrial and structural, price rises persist because manufacturers have limited alternatives. Samsung's battery technology development demonstrates silver's role. They selected silver carbon composite because silver's conductivity enables the performance characteristics they're targeting. They evaluated alternatives. Silver provided the optimal solution for their design parameters. Solar manufacturers have invested years attempting to reduce silver content per panel. Thrifting technologies, alternative conductive materials. They've made progress. But each panel still requires silver for optimal efficiency. The fundamental physics don't change. EV manufacturers face similar constraints. Silver has the highest electrical and thermal conductivity of all metals. In battery management systems, power electronics, and charging infrastructure, alternatives like copper or aluminum provide inferior performance. For high reliability applications, silver remains the standard. The supply situation is about recognition. For decades, markets treated silver as abundant, readily available, easy to source. That framework is being tested. China's export licensing challenged it officially January 1st. Now, every manufacturer, every technology company must address a question. Where will supply come from when China influences export flow and when future battery technologies could consume substantially more silver per vehicle than current designs? Early indicators suggest responses are beginning. Reports indicate some companies have approached mining companies offering premiums above market prices for physical metal delivery. That represents more than standard procurement. That suggests concern about availability. Samsung has reportedly been securing silver supply ahead of production ramps. They're not waiting for prices to moderate. They're positioning for production requirements. Because they understand if they can't source adequate silver, production timelines become constrained. Auto manufacturers are beginning evaluation. BMW's partnership with Samsung isn't solely about battery performance. It's about understanding the technology and the supply requirements it creates. Western governments are responding gradually. The US added silver to its list of critical minerals in November 2025. Recognition of strategic importance. But recognition doesn't create supply. The US imports substantial portions of its silver. Domestic production covers approximately 30% of consumption. And reshoring silver production takes time. Even if government prioritized domestic operations, offered incentives, streamlined permitting, meaningful production increases wouldn't materialize for years. The lag is structural. Europe faces similar challenges. The EU depends on imports for most silver. Flash surveys by EU business organizations found majorities expect to be affected by Chinese export controls to varying degrees.